will ever be. Tony, did you push record? Okay, we're recording. Okay. This is a little Friday afternoon THT, and it's going to be really basic on how to understand this little graph here in the middle of the scanner, or at the top of the scanner. It is very confusing, can be very confusing. I'm going to try to make it a little bit easier to understand. In the elite room this morning, Sharpie made a comment and he said, anything above this line is profit. Does everybody see my pointer, my mouse? There's a line in the middle and it says 0. Okay, that is your profit line. So anything above that, that's showing. I popped up just a couple of spreads. I just wanted to get a quick picture because I really didn't want to put the chart up that I'd put up earlier in the room. It's really confusing. So I decided to go ahead and pop up the scanner. That's what took so long. So when your spread that you're looking at is the part of it that is above this center line is when you're in profit. This line is where the underlying is now. Okay, this is your profit line. So tell me if anything, if I don't make sense, because I have not done any training like this before. So, and as I mentioned, this is a little out of my comfort zone, but hey, what better way to learn it than to try to explain it? So I just learned this last night, literally. Okay, so this, when you pop up your, to check and see what you're looking at, the way to pop it up is you click on the proximity premium column, and that will pop up. You're right there. It just popped up a different one. Okay, I take it off by pressing on this proximity premium column. Okay, that gives you a little visual of what you're looking at. Okay, for example, I'm just popping up random strikes here. Okay, this one is when it's above this line, it's in profit. When it's below, it's at a loss. And right, our underlying price is right here, so we're in a loss on this one. We would be. I'm just popping them up so you can see the difference. Okay. Okay, I think this is one I'm gonna use for an example. So in this example, we pop this one up, and this part is when it's over here at 61.40, we'd be at a max profit of 235. Does that make sense? Okay, and then down here it shows a max loss of, well, okay, 500 maybe. I'm not real good on reading this yet. So, okay, but what I wanted to show you was, then you have the second, your hedge. So say this is what you were taking for your trade right now. Okay, say we expected it to go up here and profit, but we wanted to have a hedge if it should go far against us. Okay, so we have a second, a sell up here, and that would be this one I just popped up, because it would cover anything from this point over. And so at this point, this one would be in profit while this one's in a loss. Okay, so that is very basically what this shows. This is your main. For this example, we're in a buy. So this is our main, and the blue is for buy. Our main spread, and this is where the profit or loss is. I'm sorry, this is where the underlying is. Okay, and this shows where your profit and loss should be, but it doesn't have them combined for the two. So you don't have that. It just shows this one and then this one. It doesn't show the total combined. We'll have that eventually. It's on the wish list, but we're not there yet. So when you want to click on and see where the spread would show up in this graph, you click on the proximity and premium column, and that will click up the different. There's the new one. Just clicked up. I'll click up the different things, and anything above this middle line is profit. When the price is in that zone, it's profit, and when it's below, it's a loss. Okay, is there any questions so far? And I can't promise that I can answer them real well, but I'm going to try. I'm just going to do a few real basics that I learned last night. Is it just showing the potential profit loss? It doesn't actually move. It does move as the price changes. It does move. But yeah, it shows the potential profit and loss. I mean, the numbers will change. This little bar will change as the price moves. But yeah, it just shows your potential. So you can pop these up and you can see what the difference is. And if you were to have a really good coverage, you'd have it pretty much equaling this, I think. I got to get more details on this, but for the very basics, we're just going to start with the very, very basics today. That's all I can do. And so does anybody have any questions on what this is showing? I just never got this part. So when you're in a sell, I mean, when it's coming down here and this one's in a loss, then this one's going to cover you. Yeah, Kelly, the underlying price changes, the potential profit loss changes. Okay. Now I'm really going to get into some mucky territory. I know there's a lot of people that have a lot of problem with proximity. Wait a minute. Up until the underlying price gets to the floor or the ceiling. Okay, they're just answering a question Linda had. Right. When the price gets to the floor or the ceiling, then it stops changing because it doesn't affect the spread any longer. Okay, so I know there's probably questions on what is proximity and what is premium. That's a really hard thing to grasp, but it really is not that tough once you understand it. Kind of a funny little. Okay, premium is like time. You have premium based on time left, and there's premium built into the spread so that as the day goes on, your premium declines. Premium is the same thing as saying time. That's why when you put your iron condors on and you put that kind of stuff on, you put that on either early in the morning or late at night on a daily so that you have a lot of time that you're waiting and you're going to collect that time. Below the market proximity is a negative, and above the market proximity is a positive. There you go. And why is that? Because if you are in a negative proximity, you would be at a loss, right, Jack? Oh, I'm so glad you're in here. Yeah. Okay, this is the first time I've ever tried to explain these, so I'm so glad Jack is in here helping. Thank you. And okay, so if you have a negative premium, we're talking about premium. If you have a negative premium, you're actually below the market. And if you have a positive, you're above. Okay, now proximity, that's the one that always tripped me up. That took me a long time to figure out. I can't even tell you how many times I watched spread webinars and I could not get it. But I'm going to try to explain it, so maybe it can help somebody. What finally got through to me was actually one of Kelly's articles that I was reading once. and I had an aha moment. Thank you, Kelly. Okay, so proximity is, okay, here is the where the underlying is. The proximity is where the spread is if you get in at that time. It's kind of like the price, well, it is the price of the spread. You have to overcome that proximity first. So, for example, in this one, we can get, I wish that wouldn't be there so I could see what it, there we go. Okay. Here, the proximity is a +2. Okay, so that means that, if I'm not mistaken, correct me if I'm wrong, Jack, but if the proximity is 2, that means that it would have to move 2 ticks further than the underlying in order to start making a profit. Is that right, Jack? Your proximity is the underlying is here, but if you like buy a contract, you buy a spread here, you don't start out right here. You start out where you, okay, it says 2 ticks above the market. Okay, so if you buy a spread, you don't start out right where that is. You start out 2 ticks above where the market already is on a buy. So the market has to come up 2 ticks just to have you break even and then move further. So it's really the difference between where the market is and where you get in, because they aren't going to have you just jump in and get in right where the market is. So you want low proximity. Yeah. That helps a lot because it doesn't have to move as much. And you will get the low proximity if you're taking near the money spreads. It'll mirror where the market is moving the fastest if you're in a near the market, near the money, whichever you call it in a spread. But yeah, you want that proximity to be lower. The proximity is the difference between where you get in and where the market is. Because you don't just, if the market is at, 61 here, the indicative is 61.17. Well, say you wanted to buy it 61.17. Well, in this particular one, you'd actually buy in a little above that, and the market has to come up to meet you. Does that help? Does it make sense? Right. Think of proximity as the number of ticks away from where the market is, the underlying. The indicative index is the entry on your chart. The indicative index would be what your chart says. Your chart will say, and I don't have a chart up for, what is this? Yes. Oh, yeah, I guess I do. Huh. Well, I can't really move them around because of the camera. Right now, let me see. Where is the underline? The underline is that, okay. 6117.25, 6117.4. Okay, that's what your chart will say. Well, your chart is the underline, okay. The indicative is the Nadex. But the where you get in is just a little bit different from where the chart is. The proximity, I'm gonna word this in Kelly's words. The proximity is the difference of where you get in, which is the entry price, and the difference of where the indicative price is. Correct. Because you don't, whenever you take a spread, you don't get in right where it is. The indicative is the Nadex market price, right? The underlying is our chart pricing. So there's, it's a little bit more complicated with the spreads because you have the underlying, you have the indicative, you have your chart, you have your proximity, a few more numbers, but underlying is the actual market price, the chart price. Yes, it is. Thank you, Kelly. And that's what this line is giving you. It's going to move forward and backward. That's what it's giving you. Okay, so did I like butcher that completely, or do you understand somewhat? So the indicative is the black line. No, the underline is the black line. The indicative is right up here. The underline is this. This is the price that your chart is telling you it's at right now. Okay, this is the price that Nadex Nadex has on their chart. And it's just a little bit different, but you need to follow, our systems all follow the underline. You need to follow the underline because the indicative is only important at closing. So you aren't seeing something on the graph for the indicative. No, because we are taught to trade with the underlying. And it's confusing, for sure, to keep them straight. That's why I'm trying to get just the very basics. I don't want to, go into a lot of complicated stuff, because for me, if I can just do a little piece and then kind of get it straight in my head and go over it, then I can remember it. Okay, so are there any questions? And John has a little blurb that he put in there, and he's absolutely correct, but I don't want to get that confused right now. To me, that's confusing, so I'm going to leave that out. But he's right. I think that's where I get confused, because there's too much information thrown in at me, and so I like to keep it really simple, and that's what I'm going to do for today. Just nothing big, not a big just speak slowly and repeat often. Yeah, that's no kidding. It's just, you have to underline, which is what your chart says, this vertical line. Okay, your proximity is the difference between where you get into the spread, in this case on a buy, you're getting in. That means the market has to go up 6 ticks until you break even. And now keep in mind, not every chart, these charts don't all move tick for tick with your chart that you have on your underlying chart that you have up. This is the Nadex. It has to move 7 Nadex ticks, I believe. Okay, and a sell is just on the other side, but it's the same thing. If you had a sell up here, above this 0 point is your profit, and below this 0 is your loss. Only it's just on the other side. It's on the left side instead of the right side. What are the numbers on the bottom? That's where you're, okay, right now, for example, Nadex or our NQ, which is the underlying for US Tech, is at 117.50. Okay, so that would be right. Well, according to this, it's at 120, so it ticks just a little bit different. So I can't answer that exactly. What is the mark? That's the market price. Okay, market price. Thanks, Kelly. The numbers on the bottom are the price markers. Okay, that makes sense. I think Kelly should be doing this THT. You need to clarify the proximity is NQ ticks, not Nadex ticks. 6 NQ ticks equal to 15 Nadex ticks. Okay, the proximity is NQ ticks. I thought it was, okay, I just learned something. This is what I mean by me trying to learn on camera. Yeah, interesting. Sorry, I'm confusing you. Okay, so the proximity is NQ ticks and not Nadex ticks. That's good to know. Thank you, Denali. I thought it was the Nadex tick, but I'm wrong. And the underlying tick is 0.25, yes. Nadex ticks in a 0.1. Absolutely. Well, good. I'm glad you think this is learning at the perfect speed because I feel like completely pretty clueless. Nothing new here. I said I was going to get out of my comfort zone and do this, and that helps me cement it in my head. And hopefully, you guys that are just beginning, I mean, I'm sure a lot of you are out there rolling your eyes going, oh my gosh, doesn't even know these basics. Yep, this is true. This is what I mean. You got to get in there and learn it. Get out of your comfort zone and learn this stuff. And so that's what I'm going to do. So thank you guys for helping me along as I go with this, because this is really I hope one day I can be a spread wizard, even half of as good as you really know what you're doing. Thanks for being here. Okay, so the proximity, as a little refresher, this proximity is NQ ticks. It's the chart ticks. Yeah, Kelly, I'm not going there. Because that's, to me, that's a little bit confusing. I don't want to, that is the same thing that, who just said that a little while ago? John just said that, and that's confusing to me, so I don't even want to go there. I want to stick with the very basics. The very basics is proximity is the difference between where the chart is and where you get in, because you don't just jump in right at that price. And the top half is when you're in profit. You will, if it's in this area, it is the profit on either side, buy or sell. If it's under the zero line, this is where you're at a loss. And in a hedge, you want these triangles to pretty much cover each other, so that if one goes down, the other goes up, and it is covering each other. Can you show the proximity example on the hedge? Okay, well this is and it's at a minus. The proximity is 75, so that means that it has to move 75 ticks. You're near the money here. I mean, you're not near the money. The underlying is right here. Before you start making a profit on this one, it has to move 75 ticks. Then it will start to make money. And Jack reminds us that you want this vertical tip here to be as close to the edge as you can. Yeah, this is a poor example. I just started clicking stuff up. Thank you, Jack. You really want, in a hedge, you want this to begin as soon as you start making a loss. So you want this to be right here at the edge here. Would this be a little bit closer? Then you would get hedged here if it started to go against you, but you'd only have protection 2 here. So that is because on this one, your proximity is only 3. That's why DM brought up iron condors, because NQ is not a good choice for hedges. Yeah, I just picked up whatever came first, because I just wanted to explain the basics of how these triangles work. So that's really, I just wanted to cover those very basics because that's all I'm capable of covering at this point. I am in a big time learning. So just like you guys. So for a good share of you, this will probably be just, review, and you're thinking, I could have done that in my sleep. Well, yeah, not me, not so much. So, okay, so if it's under the zero line, you're in a loss. If it's above, this is where you're in a profit. This is where the chart is right now. These are our price markers on the chart. Instead of being up and down, like we're used to them on the chart, it's up and down. In this, it's just across the bottom. Okay, so for what it is there any questions? I'm not going to get into any more detail than that because you have to understand these very, very basics first. And if you don't, then you don't want to take it to the next step without getting these cemented in. Okay, I'm going to show you the example that Daryl showed me last night. Okay, I don't really know this. Hopefully I got it in the, Tony, is this in the middle of your recording area? I'm not sure that it is. It is. Okay, good. Okay, so yeah, I'm sure you can all read this really well. Okay, so what he was trying to show me was, okay, this was the original trade, this blue area, okay, and how do we know which one it is? Because you've got this green little area in your proximity premium. It's coming up, that's highlighting that, so we know that's the one it's looking at. Okay, that's how you can tell which one it is you're looking at. The buy is blue. Okay, so you're looking at, we know the blue is this spread. Okay, does that make sense so far? It's spread 145.5 to 150.50. And yeah, ignore the Martinique writing there. Okay, I've had a request to repeat it. The original trade that we're taking in this example is expecting it to go up. So we wanted a buy that has, it's 145.5 to 150.5. And our proximity was 2 at that point. That means it only had to move 2 ticks and we were at break even. Oh, okay, this was worth it. One person just said, oh, I get this now. So this was worth it. Thank you. You just made my day. Okay, so this is the original spread that we're getting into for our trade. We saw a trade set, we're just going to assume we saw a trade set up on the chart and it indicated a buy. This is the spread we chose. This spread we chose was this right here. It was a buy, and we know that this is the one that we're looking at on the chart because it's highlighted in green in the proximity premium column. It was only 2 ticks away from the proximity, and the premium is a -2. Honestly, I'm not even quite sure what that means, but it's pretty close to, at this moment, it's pretty close to the 0 level, so it gives you a low risk even if the market goes the other way. Yep. Okay, so now we want to hedge this. This is our original trade, this blue one. So we want to hedge this. So we want to find something that is going to cover it. It's going to be really close to this vertical line. This is where the chart says we are. It's going to start making profit pretty close to that. And so the one that he pulled up was this one because it's highlighted. It was a sell at 145 to 145.5 to 148. The proximity was 30. That means if it goes short 30 ticks, we'll start to make money with it. So we aren't covered until 30 ticks. So if we get out of the trade before that, we'd lose 30 ticks. But once it hits 30 ticks, we're covered. This will begin to make money, and this will be losing money. So that's what we have, why we have our hedge. It's pretty much equal here. So it looks like, can't guarantee, but anyway, does that make sense somewhat? Linda, yeah, I'm with you. Yeah. You bought at 148 and you sold at 147.66 equals 32. Okay. We just add both proximities to calculate the risk. Subtract. Good. Thank you, Jack. Linda, you're not alone there. So what would be your profit if it went against you? It went against us. Like, geez. Okay, hang on. Okay, Linda's asking, it looks like both triangles are equal, but the hedge is actually 30 ticks away. It's 30, yeah, because right here is where it starts to profit. You're at a loss until it starts to profit. This 30 ticks is underneath this zero line. So for the first 30 ticks, you're actually not in profit. You're in a loss for 30 ticks. And once it hits 30, then this one's in a pretty good loss. Well, not pretty good, but it's at a loss, and this begins to make money to cover it. No, it's not where they overlap, it's a loss. It's where it's below the zero line, it's a loss. Daryl used the show spread range boxes on the charts to illustrate profit loss occur. Yeah, okay, well, I'm not going to attempt that right now. I'm doing good just to get through this part. Right. Wherever, Linda, wherever it's underneath that zero line, you're losing money. So if right here, if this underlying went down here, you'd be losing on both. You'd be losing just a little bit on both of them. Where the lines overlap, you're just exchanging $1 for another. Interesting. Thank you, Sharps. Where they overlap, the $32 is the $32 in risk. Okay. Sell makes the dollar and the buy loses it. Yeah. Right. So from this point on, the sell makes money and the buy loses. So that's what we're talking about. But between here and here, you have a $32 risk, if I understand that right. This line moves. These lines do not. These lines are your they're the outlines of where the trade is. This line in the middle moves. Okay. I thought you said the ticks are NQ, so wouldn't it be 30? So it wouldn't be $32. Uh, hmm, Jack, help. Um, it may be, I don't know. It's $1 a tick. Okay, that's what he's asking, Kelly. We just said that these were in Nadex ticks. I mean, these were in underlying ticks, and then now you're saying remember Nadex ticks in $1. So these are counting these are counting your chart ticks, but they have the value of $1. Is that right? The underlying ticks in 0.01. Okay, wow. Okay. Okay, so you're counting it as 30 ticks. On your chart, it's 30 ticks, and in a futures chart, it would be 30 times 0.25. You know, a tick is a quarter. But in Nadex, it's still 30 ticks on your chart, but it's at $30. Oh, yeah. Ooh, this is GP. Yeah, you're right. This isn't even Nadex. I switched it, didn't I? Yes. Silly me. Good. Good call. Sorry. I'm still thinking we were looking at the other NQ chart. So now I've just confused everybody, all the pieces, I'm sure. Yeah, probably aren't going to want to watch this recording. But do you understand the picture that's painted right here? Is there any question on the picture that's painted? I mean, the picture is, this is, we know this is the trade that's pulled up. This is the spread, the choice that you've made. This shows where it's covering. If it buys, you make profit. If it goes down, you lose. And on your hedge, then it comes up because anything above this zero line is profit. Anything below is a loss. And where the two start to go together, right here, the hedge will make $1 and the buy will lose $1. And you know which ones you have brought up here because they're highlighted in the proximity premium column. And you want your triangles to be roughly the same size on the hedge. Yes. Right. Nadex ticks in $1 increment. So do you understand a little more than you did before I started doing this, or did I just confuse everybody? To get the actual risk, you subtract the sell entry from the buy. That is how Daryl explains it. Sharpie says. It's very basic. That's why I wanted to kind of do this with you guys as I get lessons in this and as I learn more. I will go over it with you, just little pieces by little pieces, very little pieces, because I cannot do, I don't know enough to do big chunks, but I can only handle small bits myself. So I'm only going to give you small bits as I'm comfortable with them, because I mean, even a few people were going up a little and, giving us more information, and man, they know their stuff, but it confuses me. So I just want to stick with real small little bites. So what I'm going to do this weekend is go over Daryl's webinar that he had on why he likes a ranging market, and see if it makes any more sense, and see if it helps at all. And I would suggest that if you haven't already, there is, if somebody could post a link, that would be great, on the spread courses. And if we can like go over those over the weekend and then come back and ask questions, that would be great. I'm going to try and do that, and then whatever questions I have, I'll see if I can get them answered, and you guys will probably come up with more. We always say there's no stupid question, and ask the questions, no matter what. And I always used to think, wow, I don't even know what stupid questions to ask, and now I'm at that point again. So I'm not even sure I know. How do you figure the bins to cover the spreads? I'm not going there right now. I don't want to get. I just want to stick with the very basics right now. But keep that question, and we'll kind of deal with that as we go. So let's see that right. Proximity on its sell is 147.98 minus 147.68 equals 30. Max risk on the trade dollars are 148 to 147.68 equals 32. Jack, what do you say? Oh, Spreads 101 course Kelly just put up. Oh, thank you. That's good. I need to go back over that for sure. Okay, Jack said you might be able to do it that way, just showing, he's just showing how DM does it. So I got to go back over the basic spreads myself. And where is Kelly's article that helped me? Oh, geez, that was like 3 years ago. No idea. I have no idea what article it was. It was just understanding that the one thing I got out of that, I didn't know what the article was about, but I do remember that I did understand the proximity after that, that was the difference of where the underlying is compared to where you actually get in, because I didn't understand that you got in at a different spot. I just thought, well, geez, the price is at 4,700. That's where you get in. No, doesn't work that way. That's what you have to understand is, the price on your chart may be at 4,700, but when you buy a spread, you don't get in at 4,700. You get in at whatever the proximity says. The difference of the proximity is where you get in. Somebody says 10, that means it has to move 10 ticks before you're at that 4,700, before you're at break even. That's somebody said, we'll look at Darrell's webinar again. Maybe some of it will make sense. That's what I'm kind of thinking. I mean, I literally learned this stuff at midnight last night, so I kind of knew I knew the proximity part, but I did not have any idea how to read that picture. I was completely confused. So now I'm thinking maybe going back and watching some of this stuff might help. not any great, definitely out of comfort zone here because I don't have a clue. That's okay. We're going to learn this together. And I love this, traders helping traders, because we've got so many people in the elite room right now giving me tips on what to say because people are asking questions and I don't have a clue. So this is truly traders helping traders. Thank you. So I'm pretty much done with what I wanted to go over because I only wanted to hit the very basics. And after I go through some of the courses, I might be able to explain a little bit better. But right now, this is as good as it gets. It's gonna be just little bites. How do you eat an elephant? One bite at a time. Well, spread everything is an elephant to me. So let's do it one bite at a time together. Figure this out. So if I'm doing this, I don't want to hear anybody complaining about they don't want to ask questions.